Good evening, and today we are going to discuss the preparation of financial statements and accounting adjustments, basic accounting adjustments. Right, so this is one of the key area in the syllabus, in your syllabus. Right, so before I move on to the preparation of financial statements, first let's see some theory areas. Right, so first you can write down this. Write the main heading: preparation of financial statements. Preparation of financial statements. That's the main heading to this chapter. So when it comes to the financial statements, we have the components of financial statements. So basically, there are 5 components of financial statements: statement of profit and loss, statement of financial position, statement of changes in equity, statement of cash flow, and notes to the financial statements. So these are the components, right? So initially we will prepare the financial statements for a sole proprietorship, for a single ownership. So when it comes to the sole proprietorship, we will prepare only the first 2 statements: statement of profit and loss, statement of financial position. Right? So the companies, we prepare all 5. For limited liability companies, we will prepare all 5 components. But initially, right now, we will focus only the sole proprietorships. Then the elements, there can be MCQ questions: components and elements of financial statements. When it comes to the elements, we have 5 elements: assets, equity, liabilities, income, and expenses. Right? So we use the elements of financial statements to prepare the components. Okay? So this is the process. Financial statement preparation process. Preparation process. So now in our previous sessions we discussed preparation of trial balance until preparation of trial balance. Now from the trial balance we have to prepare the income statement, or the statement of profit and loss, and statement of financial position. So how do we prepare this? In trial balance we have the elements: accounts, income, expenses, asset, equity, liabilities. Right? So by taking the income and expenses, we prepare the income statement. Income statement shows the financial performance of the business. Financial performance. So the performance is measured using the net profit. The performance of a business is measured using the net profit. So how do you calculate the net profit? Net profit is equals to income minus expenses. So if you take this example, income is 3,000, expense is 2,000. So the net profit is 1,000. Then we prepare the statement of financial position to show the financial position of the business, the liquidity position and the asset. Right? So here we show asset equals equity plus liabilities. This is the starting point that we learn under accounting equation. So the total asset here is 8,000, which is equals to equity plus liabilities. So when there is a profit, the profit will be added to the equity. So financial position shows asset equals equity plus liabilities. Equity plus liabilities. Profit and loss is prepared for the year. And financial position is prepared as at end 31st March 2021. This is for the year, prepared for the year ended 31st March 2020. Okay, so this is the process. Can you all draw this? Spells it out. To explain the process again, I will explain it again. Right? Others can write down the preparation process. Now we prepare the trial balance, right? By taking the transactions. Now in the previous classes, I have discussed how to prepare the trial balance. Right? So once we prepare the trial balance, in trial balance we have 5 types of accounts: income, expenses, assets, equity, and liabilities. And taking these accounts, we have to prepare the financial statement. So financial statement means in a sole proprietorship, we prepare only the income statement and statement of financial position. Right? So income statement, using the income statement, we calculate the net profit. How do you calculate the net profit? Income minus expenses. So we take income and expenses from the trial balance. Income minus expenses will be net profit. Income minus expenses will be net profit. And we take the remaining 3 accounts. Assets. Assets is equals to equity plus liabilities. This is the basic accounting equations. We show this in a statement of financial position. What business owns equals what business owes. So asset is 8,000. Capital or the equity will be 6,000 plus the net profit, because the profit will be given to the owner. Here we calculate the profit 1,000 that will be added to the capital. Plus liabilities will be total equity plus liabilities. So total equity plus liabilities equals to the total asset. So we show this in the statement of financial position. So this is the preparation process. Okay, so draw this. Next I will explain the format. Income statement shows the financial performance. Statement of financial position shows the financial position of the business. Now I will show the format of income statement and statement of financial position. Now, as I said, in income statement we calculate the net profit. Net profit equals income minus expenses. But when preparing the income statement, we don't write the total expense, income and expenses. We have to categorize. We have to categorize the income and expenses. Right? So let's check the income statement. Right? So this is the income statement. You all can draw this. In income statement, we have income and expenses. Then we divide the income. In a business, the main income is sales. Main income is sales. And the main expense of a business, here we mainly focus on trading businesses. Business which does buying and selling. Right? So the main expense of a business is cost of sales. Right? I will share this presentation in the Google Classroom. You can download it. So just focus. The main income of a business is sales, and the main expense of a business is cost of sales. Sales and cost of sales. Right? So when it comes to sales, we have to take the net sales. So how do you calculate the net sales? From the sales, if there is any returns, we have to deduct. So sales minus return inwards will be the net sales. Right? Then the cost of sales is calculated using an equation: opening stock plus purchases minus closing stock. If there is any return outwards, that should be deducted from the purchases. And also, if there is any carriage inwards, the transportation cost, taxes, duty, so those expenses will be included to the purchases. The cost of sales is calculated opening stock plus purchases minus closing stock. Right? So when calculating the profit, initially we take the main income minus the main expense, cost of sales. Right? So if we deduct the cost of sales from sales, the answer that we get is equals to gross profit. Gross profit. Then we add all other income or other income of a business. Other income. Other income means other than the sales, the business will have interest income, rent income, dividend income, profit on disposal, selling an asset, discount received. Right? So we add other income and deduct all the expenses. So expenses are categorized into 4 types. So once you deduct the expenses, you will have the net profit. Okay. Expenses are categorized into 4 types: administration, selling and distribution, finance expense, and other expense. Administration means those are the expenses within the office and administration related. Examples: electricity, rent, rates, stationery, printing, right? Building maintenance, salaries, office related expenses. Selling and distribution expenses means expenses related to sales and distribution, advertising costs, carriage outwards, bad debt, doubtful debt, right? Sales commission, right? Showroom rent, motor vehicle depreciation, motor vehicle maintenance. Those are selling and distribution expenses. Finance expenses are expenses related to the bank loan and debentures, bank bank loan interest, lease interest, checkbook charges, bank charges, anything related to bank and finance. Other expenses are any other extraordinary expenses like donations, disposal losses, damages, write-off, right? So these are other expenses. Okay, so in income statement, we take the sales minus cost of sales equals gross profit. Then we add the other income and deduct expenses. Then the answer is net profit. So this is the summary of income statement. Then we have to take the statement of financial position. So in financial position, we have the assets and liabilities. Assets will be divided non-current assets and current assets. Liabilities will be divided non-current liabilities and current liabilities. Then the equity is equals to capital plus net profit minus drawings. These are the items in the statement of financial position. Right? Okay. And then preparing the financial statements using the trial balance. When preparing the financial statements using the trial balance, we make accounting adjustments. We will do some adjustments. So write down the adjustments. Okay, so I will keep the adjustments, accounting adjustments. So these are the important things. Accounting adjustments. Number one, they will explain inventories. Adjustments related to inventories. Adjustments related to inventories. Right? Under inventories, we have closing stock adjustments, closing inventory. Then we, under closing inventory, the cost realizable value adjustment, cost and NRV. Under inventory adjustments, we have cost and NRV adjustment. I will explain that. Then we also have stock damages, losses, and insurance claim. Stock damages, losses, and insurance claim. Then we also have stock drawings, then stock sold on sale or return basis. Stock sold on sale or return basis. So these are the adjustments related to inventories. Right. So I will explain one by one. Most important thing in the financial preparation of financial statement is accounting adjustments. But if you can do these adjustments, you can do any question from company accounts to partnership to sole proprietorship, incomplete records, non-profit organizations, right? So all the questions are based on the accounting adjustments, right? So number one, you need to know the inventories. Number two is trade receivables or the debtors, adjustments related to debtors. So debtors related adjustments, we have two main adjustments. One is bad debts, bad debts, and one is provision for doubtful debt. Provision for doubtful debts. Bad debts and provision for doubtful debts. Two adjustments related to trade receivables. Bad debts and provision for doubtful debts. Number three, adjustments related to accruals. Accruals. I want you all to write this down. Adjustments related to accruals. So under accruals, we have income related and expenses related. When it comes to expenses, there is expenses payable and prepaid expenses. Prepaid expenses. And income related, income receivables and income received in advance. So four transactions related to accruals. Four transactions related to accruals. Number four, adjustments related to property, plant and equipment. PPE. Property, plant and equipment is also one of the key adjustment. Under this, we have depreciation adjustment, depreciation adjustment, then disposal can be a sale, transfer or exchange, damage. Disposal of motor vehicle, selling a vehicle or exchanging. You are giving your old vehicle and buying a new vehicle. Or damage due to an accident. There's a damage, so you remove the motor vehicle from the accounts. Disposal, we call it disposal of PPE. Like depreciation, disposal, and we also have revaluation adjustment. Revaluation related to PPE. So we need to learn these three major or key areas under PPE. So initially for the sole proprietorships, we learn these adjustments. Right? Accounting adjustments. Then when it comes to company final account, we have EPF, ETF adjustments. Then we will have taxation adjustment and some of the accounting standards related to this. But here I'm mainly focusing on few adjustments that later when I do the accounting standards and company final accounts, I will do all the related adjustments. So here I will be focusing on few adjustments for now. Okay, so can you all complete this? Write this. Right. So next, what we'll do is now we need to I need to explain one by one, right? So before that, we'll do a basic complete question. After that, once you have an overall picture about preparation of financial statement, I will explain the adjustments one by one. So first, I will explain a basic question, this question. Right? After that, one by one, we will do the adjustments. Trade inventories, trade receivables, right? Then the accruals. We have different types of accrual adjustments, right? Then the PPE. Okay, so first we will just prepare a basic income statement and a statement of financial position. Now, this is the question. Right, I have sent this question in the WhatsApp group. So the question is, NN Traders is a sole proprietorship owned by Nishant. The trial balance is given. Trial balance is given. PPE, accumulated depreciation, stock 1st of April, trade receivables payables, drawings, provision for doubtful debt, purchases sales, showroom rent, electricity, water, salaries and wages, maintenance expense, cash at bank, cash in hand, advertising, capital 1st April 2016. So these are the balances from the trial balance. Right? Then there are adjustments. The closing stock adjustment, then the depreciation adjustment. Right? This adjustment is closing stock, that is related to inventory. In the depreciation adjustment related to PPE. Then write-off balance receivable means this is bad debt. And provision for doubtful debt, 5%. And the fourth adjustment, opening a new showroom, which is accrual adjustment. Like normally, you will get adjustments in a sole proprietorships, adjustments related to these four, the adjustments that we discussed. Okay, these four adjustments. Right. So since this is the first question, I will explain from the basic, right? Draw this format. This is the format of income statement. Sales minus cost of sales is gross profit. Right? Then you add other income and deduct all the expenses. Administration, distribution, finance and other expenses. In the statement of financial position, we have non-current assets, current assets equals to total assets. Then equity, capital plus net profit minus borrowings, non-current liabilities, current liabilities, and total equity and liabilities. Your final answer, total assets should be equal to total equity and liabilities. Right. So let's start recording the transaction. And what you need to know is all the transactions in the additional information. The transactions in the additional information, you have to record in two places. Double entries must be recorded. Additional information, two entries. Right, and right here, additional information, two entries. Trial balance, information in the trial balance, only one entry, single entry. Right, so that is important. Whatever you take from the additional information, you have to record in two places. Additional information, two entries. Information from the trial balance, only one entry. Okay, so we will start with additional information. First step is drawing the format. Step 1 is the format. And step 2 is the additional information. Right? I'll write the steps in final account questions. Steps in final account questions. Number 1 is format. You need to draw the format. Number 2, additional information. Number 3, step number 3 is trial balance. Step number 4 is final balancing. These are the steps. Okay. So these are the steps. Additional information, two entries. Trial balance, only one entry. So first step is format. You need to draw the format by keeping space. But some people might start from sales and try to do from here, from sales to cost of sales to other income. So we don't use that method. That method is wrong. We use to do following this step. Like first, a complete format should be drawn. Right. Now let's record the transactions from the additional information. Right. I hope you have the format. So we'll start with number 1. The closing stock as at 31st March 2017 is valued as follows. Closing stock. Cost is 5.4 million. Net realizable value is 5,450,000. Right? So what is mean by net realizable value? Net realizable value means expected selling price. Expected. Later I will explain. We are planning to sell at 5,450,000. So it is higher than the cost. So when we take the balances into accounts, we take the lowest into the accounts. So what is the lowest here? Lowest here is the cost. Cost is the lowest. The lowest from cost and NRV is the cost. So we need to take the cost into our accounts, our financial statements. And the current asset, stock account debit 5,400. So we will type here under closing stock 5,400 and cost of sales 5,400. So we record that in 2 places. Right. In this question, you record it later. When I explain the inventory adjustment, I will further explain in depth. Additional information goes to 2 places. Stock account debit, cost of sales credit. From this question, what I need is to understand the format. Only the format. Later, we'll do more complex adjustments. Okay, so inventory goes to 2 places: current asset under closing inventory, and cost of sales. For purchases, we deduct closing stock. Right? In the second adjustment, value of the land is 4 million. Land is 4 million. And the depreciation policy of the business is to depreciate the property, plant and equipment on straight line basis at cost using the following rates. So from the cost, building will be depreciated 10% per annum. Per annum means per year. Office equipment will be depreciated 20% per annum. Furniture and fittings will depreciate 25% per annum. Now first step, we need to identify the non-current assets. So there are 4 non-current assets. 4 PPE. Land and non-current asset, you have to write the cost of these assets. right? We have land, building. Since the land cost is separately given, you have to separate it in the non-current assets. Land, building, office equipment, furniture and fittings. Land, building, office equipment, furniture and fittings. Right? Then you have to record the cost. Cost of the land is given 4,000. In the additional information, it says value of land is 4,000. 4 million means 4,000. Then how much is the building? If the land is 4,000, total is 10,000. Therefore, building is 6,000. So you have to separate the land and building. The reason is we don't depreciate land. Book value is 4,000. Net book value. Land cost is 4,000. Book value also 4,000. There are a few questions. Why we are not taking 5,450 is we have to take the lowest of cost and NRV. So when it comes to inventory, we take the lowest of the cost and NRV. So here the lowest is cost, 5,400. So you don't take the NRV. What is the accounting concept related to this? Inventory is valued at the lowest of cost and NRV. You can remember the accounting concept. What is the concept? That's prudence concept. Prudence concept. If the NRV is less, we have to write off. If the NRV is more, we don't write off. We don't add the profit based on realization concept. That's one doubt. There is another question. Land. Here, land and building cost is 10,000. Land and building cost is 10,000, and the land cost is given. Value of land is 4,000,000. Therefore, you have to write the land 4,000, building is 6,000. Right? Then the accumulated depreciation, this is the cost. Only building will be depreciated. Land we don't depreciate. Therefore, the book value also 4,000 flat. Now we will calculate the depreciation of building. There is a question. Can't we write land and building together in SOFP? You can't if they have separately given the land value. If they have separately given the land value, you have to show it separately in the statement of financial position. You can't record together. It's not wrong, but better to show the information. If you have the information, it's always better to show the separate information. So it's not wrong, but you have to show separately. Right? So is there a liquidity order? Yes. So when it comes to writing the assets here, on the top, we write the lowest liquid asset. Liquidity. We have to write the asset based on the liquidity. Lowest in the top, lowest on the top, highest liquid asset on the bottom. So what is mean by liquidity? Liquidity means how fast you can convert an asset into cash. Cash means the cash in hand, rupees and cents. So the lowest liquid asset is land. So always on the top you have to have the land, then building, then the machineries, office equipment, that these can change. But on the top you should have the land. So when it comes to non-current asset, the lowest liquid asset is the land. So always on the top you have to start with land and building. After that only you can write the motor vehicle, equipment, furniture, machineries, all you can record here. And current asset, always you have to start with the inventory and trade receivables. After that, you can have all other current assets like short-term investments, prepayments, receivables. Then on the last, final current asset should be cash in hand. That's the 100% liquid, 100% liquid asset is cash in hand. Before that, you can have the bank balance. So when you are recording the assets in the statement of financial position, it should be based on the liquidity. It's starting with land building. Current asset, you start with closing stock and the trade receivables. And current liabilities, you start with trade payables. So liquidity is important when recording the assets liabilities in the statement of financial position. Thanks for asking that question. Yeah, furniture, office equipment, machineries, those things can change. Mainly what you need to look is land and building, in current asset, closing stock and trade receivables, current liabilities, trade payables. And here the last asset should be cash in hand. Others can change. You can change other items. Like office equipment and furniture things, this can change. That doesn't matter. But on the top you should have land. Here you should have this. So let me know if there is any other questions. Land is 4 million, building is 6 million, office equipment 6.5 million, furniture and fittings 5 million. So we took the cost of each asset. Cost of each asset will be taken to the non-current assets. Cost. Right? Then we have to calculate the depreciation. So we will do a small working for depreciation. So I'm going to do a working for depreciation. Working number 1. So this is my working number 1. For depreciation. Calculation of depreciation. Working number 1. Calculation of depreciation. Right. So there are 3 assets. There is a building and there is a building, office equipment, 3 furniture and fittings. Right. So there are 3 assets. Then we have to calculate the depreciation. Depreciation rates are given. Building is 10%. Here the rates are given. Building is 10%. Office equipment is 20%. Furniture and fittings is 25%. So we will calculate. Building value is 6,000 into 10%. 6,000 into 10% is 600. That is the depreciation expense. We calculate depreciation expense. Office equipment is 20%. Office equipment cost is 6,500 into 20%. Furniture is 5,000 into 25%. 25%, yes. So we have calculated 6,500 into 20% is 1,300. 5,000 into 25% is 1,250. So these are the expenses. And these expenses will come under income statement. We have to take these expenses to the income statement. Building, office equipment, furniture and fittings, depreciation. All three are administration. Building, office equipment, furniture and fittings, all three administration expenses. So let's take them into the income statement. Building depreciation is 600. Office equipment depreciation 1,300. Furniture and fittings depreciation 1,250. So first we take depreciation expense of each asset. Depreciation expense of each assets will be debited to the expense account. Debited to the expense account. Then to calculate the closing accumulated depreciation. Accumulated depreciation, this amount which goes to the statement of financial position. Now, how do you calculate the accumulated? Is these are current year, and in the trial balance they have given the opening depreciation. Building is 2,600, equipment 1,500, furniture 2,500. So these are previous old depreciation. And to calculate the closing, you have to add opening plus current year depreciation. Depreciation double entry is depreciation expense account debit, provision for depreciation for the accumulated depreciation account credit. Now in working, I have taken opening balance. So opening balances are 2,600 building, 1,500 office equipment, 2,500 furniture and fittings. So if you add the opening and current year depreciation, you add depreciation to the current year plus opening, so you will get the closing depreciation balance. This closing accumulated depreciation balance which goes to the statement of financial position. And this goes to the income statement. Like current year depreciation goes to income statement, closing balance goes to statement of financial position. So under accumulated depreciation, building is 3,200, office equipment is 2,800, furniture fitting is 3,750. So then you will complete this. There is a question. So you have to minus the stock. Stock. NRV calculation I will explain right separately. We have to take the lowest of cost and NRV into the account. So here the lowest is 5,400. We took that under current asset and cost of sales. It's the inventory adjustment I will explain. When it comes to inventory, there are two methods or two scenarios. In first scenario, the NRV is less. The second scenario is NRV is higher. For exams, there's a question for the exams. Do we need to show the double entry or calculation? Uh, in MCQs, sometimes they might ask in the MCQs the double entries. So most of the times, the calculations only. You have to prepare the financial statements. I will give the double entries for all these adjustments. Okay. So from this question, I want you all to understand the formatting part. Then one by one, I will explain the adjustments. Okay. Now the net book value of asset is cost minus accumulated depreciation. Cost minus accumulated depreciation is net book value. In the total amounts, we have to take here 11,750 is the total of the non-current assets. There is a question. So should we show the adjustments? These adjustments you have to show in the financial statement. These are the adjustments. Now, in yellow color, which I have highlighted, these are the adjustments. You get marks for this. Now, when the marking scheme is given, this is 1 mark for this. 1, 1, 1, 1. This is how you get the marks. But if you have done up to this point, now let's say this question has 20 marks. So if you have done only these things, you will get 1, 2, 3, 4, 5, 6, 7, 8 marks. Already you have got the 8 marks out of 20. If you complete only up to this point. Calculations, no need. It's not must. The marks will be given only for these values, the final values which is in the financial statements. So you don't need to show the double entries or anything. It's not must. Showing the calculation is not a must. If you have the final answer here, it is fine. If you can show the workings, it will be better. I always prefer to show the workings. Like when I do the exam, I write all the workings. Whatever I do, any simple calculation, I will show in my answer. When the examiner or the person who is doing the marking, he knows that I have done the calculation. There is another question. So in SFP, is there a specific column to record the inventory? Is it okay to straightly record at the last column? No, last column you keep it for the total. The last column you have to keep for the total. Right here, total of non-current asset, total of current asset. Right. Other calculation you do it here. And in the equity also, in the last column, equity, non-current liabilities, current liabilities. You take only the final values to the last column. Everything else you try to take to the second column. Right. So we have done the closing stock adjustment and the depreciation adjustment. Two adjustments done. Right. Next we have one of the important adjustment, bad debt and doubtful debt. Right. So let me explain this adjustment. Nishanta decided to write off the balance receivable from Ruan amounting to 500,000 as bad debt, and the general provision of 5% for doubtful debt should be made on the remaining trade receivable balance. Right. So when it comes to trade debtors, but later I will explain this, we have bad debt and provision for doubtful debts. Bad debt means unrecoverable debts. That means if the debtor is bankrupted or dead, we can't recover the money from the debtor. We can't recover the money from debtor. So the double entry for the bad debt is the expense account debit. Bad debt account debit, debtors account credit. That's the double entry for bad debt. Right? So the second part is provision. Provision for doubtful debt means it is estimated amount of bad debt, or it's a doubt on receiving cash from the debtors. You have a doubt on receiving cash from the debtors. Right? And the doubtful debt, you can divide specific provision and general provision. Specific provision means provision made for a specific person. Let's say Mr. Pereira. You know the person, so you make a specific provision for that, 100% for that specific person. General provision means you make a percentage from the total debtors. Okay. So here in this question, we have a bad debt of 500,000 for one. Bad debt for one is 500,000. General provision 5%. General provision 5%. Okay. Now let's do this adjustment. In the trial balance, we have trade receivables 18,500, provision for doubtful debts 750. So I'm going to take these two balances to a ledger account. I'll repeat, trade receivables 18,500, provision for doubtful debts 750. So let me draw two ledger accounts. Trade receivables balance brought forward 18,000. Provision for doubtful debt, it's a credit balance 750. Is it correct? 18,500 and 700. 18,500. So I am drawing the trade receivables account and provision for doubtful debts account. Working number 2. Okay, so this is the working number 2, bad debt and provision for doubtful debt. I can write this working number 2, bad debt and provision for doubtful debt. I am drawing the two uh, ledger accounts. One is trade receivables, the debtors, and provision for doubtful debt. Opening balance, receivables 18,500, provision account, credit balance 750. A very, very important adjustment. Definitely you will get this in many places. Non-profit especially in the incomplete records, the preparation of financial statements and company final accounts, definitely you will have this adjustment. It's a compulsory adjustment. So first thing, I'm writing the opening balance. 18,500. 18,500. I took 18,500. Now let's do the bad debt. First step, step 1 is bad debt. Bad debt is 500,000. What is the double entry for bad debt? Trade receivable account credit. Trade receivable will reduce by 500. So we credit the trade receivable account by 500. Right, so bad debt double entry. Bad debt double entry is bad debt expense account debit. Bad debt expense account debit. Trade receivables credit. Okay, so that's double entry for bad debt. Okay, so here is the trade receivable account. We have credited 500 and the debit entry goes to the income statement under distribution expense. Bad debt. $500. Distribution expense, bad debt 500. Okay. Here we credited, distribution expense credited. Double entry for bad debt. Double entry for bad debt. Bad debt expense account debit. to the income statement, and trade receivables account credit 500. Now, from the remaining trade receivables, we have to make 5% provision. So how do you get the remaining trade receivables? Balance the account. Balance carried down, balance brought home. Remaining trade receivable is 18,000. Right? Remaining trade receivable is 18,000. Now the second step. Step 2. Provision for doubtful debt. Now we need to calculate the provision. How much is the provision from the remaining 5%? How much is 5% from the remaining? 10% is 1,800, 5% is 900. So the doubtful debt is 900. Doubtful debt is 900. $18,000 into 5%. 18,000 is the remaining. It says, I'll repeat again. A general provision of 5% for doubtful debt should be made on the remaining trade receivables. Remaining is 18,000. From this, 5%. Okay. Now already there is 750 in the provision for doubtful debt account. Already there is an opening balance of 750. So this should be 900. Therefore, we need to increase the provision by another 150 only. This is the expense, doubtful debt. This is doubtful debt expense. Increasing the provision. So there is a under provision. Total amount should be 900. See, then only the total becomes 900. Total should be 900. Already there is a provision of 750. Therefore, increase the provision by 150. Then the double entry is doubtful debt account. This is under provision. Provision for doubtful debt. Within bracket, we can say under provision. Under provision. Double entry is doubtful debt expense account. Debit. Provision account. Provision for doubtful debt. Credit. Only 150. Because already 750 is there in the account. This is 500. So write down these double entries. You can write the double entries. Bad debt double entry, expense account debit, trade receivables credit, provision for doubtful debt, expense account debit, provision account credit. So provision account credit 150, and that will be debited to the distribution expense. Here, distribution expense, you have to debit doubtful debt. Doubtful debt, only 150. This is under provision. There is a question. Sir, if there is no opening balance, we can directly write 900. Yes. If the opening balance is 0, let's say this is no opening balance, then this should be 900. So 900 will be transferred to income statement. If the opening balance is, let's say, 1000, then it comes over provision, the opposite side. Then it will be deducted from the expense. Some people will take it under other income. So what I do is normally we take it minus from the expense. Okay. We will do further questions related to doubtful debt when I do the individual explanation of adjustments. Okay. Now this is an overall picture for bad debt and provision for doubtful debt. Bad debt and provision for doubtful debt. So you can copy this answer. That is done. And the trade receivables closing balance is 18,000. We have to take the closing balance. Provision is 900. Then the net balance we take to the second column, 17,100. So we have taken the trade receivables. 18,000 is the closing balance. If you want, you can write here within bracket. There was 18,500. That from 18,500 we deducted 500 as bad debt. Then there was 750 opening balance provision, and we increased the provision by 150. So here also I'm writing within bracket what has happened to the balance. And you can see the amount I took from the trial balance, only one entry. Yeah, 18,500 and 750 in one place. But 500 recorded in two places. 150 recorded in two places. Credit and debit. 500 credit and debit. 18,500 and 750 only once I have recorded. 500 and 150 recorded the double entry, two places. Receivables credit, expense account debit. Then doubtful debt, expense debit, provision credit. Okay. Then the last adjustment. Last adjustment is Nishant opened a new showroom of NN Traders on 1st of April 2016, and the rent for the new showroom is 150,000 rupees per month. So this was at the beginning. 1st of April 2016, year end is 31st March 2017. And if you check the trial balance, there is a showroom rent of 1,500, 1.5 million paid. Whatever in the trial balance is the paid amount, which comes from the cash. Remember, the amounts in the trial balance is the cash paid amount. So rent is paid 1,500. Right, let's do another working. Working number 3. Let's take showroom rent. Showroom rent. Right. So this is the financial year from 1st of April 2016 to 31st March 2017. 12 months. So showroom rent should be equals to it's 150,000 rupees per month. So 150,000 into 12 months. 150,000 into 12 months means it's how much? 1,800. 1,800. But paid only 1,500. Therefore, payable 300. So you identify the payable amount. 1,500 paid, 300 is payable. So first you need to calculate the payable amount. Right? So which is administration expense. So here under administration expense, sorry, it's for administration, it's distribution, showroom rent. Showroom rent 1,500 is paid, 300 is payable. So total expense is 1,800. So according to the accrual based concept, total expense relevant for the year comes to the income statement. Not only the cash payment, any payable balance will be added. And it is a current liability. Current liability, here we will take accrued showroom rent. So showroom rent payable. Accrued showroom rent is 300. So we take it with standpoint. 300. Accrued showroom rent is 300. Okay. So for this, now all the adjustments are done. For these only you will get the main marks. Now here 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 marks already given for this question. Out of 20, already 15 marks given, even though you don't complete. Like the marks are allocated for the adjustments. Now this is the second step, format and additional information. Now the third step. Now initially I have given the steps. Format is done, additional information is done. Now the third step, remaining values from the trial balance. What are the remaining values? We have stock. Open stock is 2,800. Trade payables is 16,600. Drawings 1,300. We have to record in the correct places. Purchases 20,000. Sales 37,000. Electricity 2,550. Administration expense. Water administration expense 1,500. Salaries and wages 3,500. Administration. Office maintenance expense. Office maintenance expense 1,650. Cash at bank and cash in hand 3,700. Bank and 1,900. Advertising expenses 1,100. Capital opening balance 20,550. That's it. Now let's calculate the total values. Why is showroom rent is distribution expense? There is a question. Why showroom rent is distribution? Showroom is used for the sales purpose. We have a showroom for the sales purpose. So this is selling and distribution. That's why showroom rent is comes under distribution expense. Cost of sales. There's no other income. What is the net profit? If you have any doubts, you can ask. Others can calculate the total. So net profit. Gross profit is 19,600. Net profit is 3,700. Balancing for 39,850. So now once you know the structure, how we do the adjustments, it will be easy for us to do the accounting adjustments one by one. Now you know where double entries goes: income statement, statement of financial position, right? And I can explain the entries one by one. Is it clear? Right. So I'll go through again. And if you want to take any screenshots, you can take. We started with this preparation of financial statements. There are five components and five elements. Then the preparation process. On income and expenses, we prepare the income statement. Using the asset equity liabilities, we prepare the statement of financial position. Income statement shows the financial performance, and statement of financial position shows the financial position. Okay, then we did this example. Now I will explain the adjustments, right, once you complete this. Okay, so shall we move to the next part? Right. Then I will explain the close adjustments one by one. So you can write the summary note. Okay. So here I'll explain the inventories. The inventories number one is closing inventory. Closing inventory should be valued at the lower of cost and NRV. Better you write this note. This is the summary. Write the first adjustment inventories. Under that closing inventories. Closing inventory should be valued at the lower of cost and NRV. Closing inventory should be valued at the lower of cost and net realizable value. Net realizable value means it is equals to expected selling price minus expected selling expense. That is NRV. NRV. Right, I will explain what is NRV. Let's say for an example, we have a business buying and selling milk packets. Right, so each milk packet we purchase at 30 rupees and we sell at 50 rupees. Right, this is the cost. This is your expected selling price. Normal selling price is more than the cost. We normally sell at higher than the cost. So that is the normal situation. So when it comes to a normal situation, cost is less, NRV is high. So if the NRV is high, we don't take the NRV, we take the cost. The double entry will be inventory account debit 100, cost of sales account credit 100. That's the double entry. So this is what we did in the previous question. This is what we did in the previous question. Inventory account debit, cost of sales account credit. And sometimes you will sell this at less than the cost. Let's say you purchase at 30 due to some damage, or if the expiry date is very close, you want to sell it fast as possible. So you sell this at 25 rupees. This is the expected selling price. And to sell this, let's say you have to put an advertisement or you want to put a banner. So there is 2 rupees expense. Then the net amount that you receive is 23 rupees. So this is called NRV, net realizable value, equals expected selling price minus expected selling expense. So this is an abnormal situation. You are selling less than the cost because of damage or expiry, planning to sell at a price lower than the cost. This is planning. Remember, this is planning to sell. Still you didn't sell it. So this will make a future loss. It will make a future loss. So according to the prudence concept, this loss should be recognized. We have to recognize this loss. So how much is the loss? Let's say cost is 100, NRV is 80. So 20 is the loss. So we have to take this loss into the income statement. Stock written off 20,000 and inventory account should be debited only 80,000. This is the amount goes to SOFP. And cost of sales, we take the cost income statement. Right, so can you write this? Inventory, closing inventory, normal situation, we take the cost, and the double entry is this. Abnormal situation, double entry is this. There is a question, stock written off comes under which expense? This is other expense. In income statement, other expense. Stock written off, other expense. Okay, shall we move to the next one? Next, I'm going to explain the debtors trade receivable adjustment. Trade receivables. So this is very important. Right, so already I roughly explained trade receivables. I'll go through again. So in trade receivables, we have bad debt, provision for doubtful debt. Bad debt means unrecoverable debts, that you are not getting the money from the debtor. Double entry, bad debt account debit, debtors account credit. Provision for doubtful debt means there is a doubt on receiving cash from the debtors. Either you might receive or you might not receive. So this has two parts, specific provision and a general provision. Specific provision means you make a provision for a person, a specific person, and general provision means it's a percentage from the total debtors. Okay, and general provision, specific provision, there can be under provision or over provision. Under provision is what we have done in the previous example. Income statement debit, provision for doubtful debt account credit. If it is an over provision account debit, income statement debit, opposite end. Okay, now we will do some examples. To understand this, I will explain some examples. So example 1. So I'm going to do this example. Right, so this is the example. Example 1. There is no opening balance. Example 1 is without opening balance. Right, so following details are given for Amal traders. Following details are given for Amal traders. Trial balance as at 31st March 2020. Trade receivable 100,000, bad debt 20,000. Additional information. Bad debt written off 10,000 and from the remaining trade receivables 10% should be provided as doubtful debts. In I need two accounts, trade receivables account and provision for doubtful debt account. And this. So these are the ledger accounts that I need, and I'll show the draft income statement and draft statement of financial position. Now we know the draft, when I explain the income statement, you know where to record, because already we have done a complete question. In trade receivables account, the balance brought forward is 100,000, and provision for doubtful debt account, balance brought forward is 20,000. Only one entry goes here. Right? So in current assets is trade receivables on that data. provision for doubtful debt. Also, sir, 20 opening balance, no. There is no opening provision. That is bad debt. 20,000 is bad debt. Sorry, I didn't see that. Thanks. So 100,000 opening balance, trade receivables, and the bad debt is 20,000. Okay. So first step, we have to write off 10,000 bad debt. Debtors account credit 10,000. Bad debt account debit. So already in the bad debt account there is 20,000. And we add 10,000, which is provided at the end of the year. So total bad debt is 30,000, which is an expense. Already 20,000 is provided as bad debt. And end of the year, and the additional information, we have another 10,000. And closing balance is 100,000 minus 10,000. So balance brought forward is 90,000. That's the trade receivable balance. And provision for doubtful debt is no opening balance. So in the previous question, someone asked me, if there is no provision, how do you calculate? Right, so journal entries also you can report. Calculating the provision for doubtful debt. That's 90,000 into 90,000 into 10% is 9,000. So that's the provision for that. Double entry. Provision account credit 9,000. Income statement. This is under debit 9,000. So the closing balance is 9,000. Okay, so trade receivable is 90,000. Provision is 9,000. Net amount is 81,000. So this is example 1, when there is no opening balance. So journal entry was bad debt account debit. Provision for doubtful debt. Doubtful debt. Provision for doubtful debt on credit 9,000. So complete number one. Example one is without the opening provision. There is no opening provision. Okay. Then example two. So I'm going to do the next example. With opening provision. Let's do under provision. Example two. Same example, I'll do some changes. Example two. With opening provision. You can say under provision. Following details given for demand payments. Trade receivables 100,000. Trade receivables 100,000, and we will have an opening provision. Provision for doubtful debt. First of April 2019. 1st of April 2019, 50,000. Bad debt is 20,000. Okay, that's it. Bad debt written off 10,000, and from the remaining trade receivable, 10% will be written off as bad debt. Doubtful debt. So this is the example. Shall we do the ledger accounts and the draft income statement and statement of financial position? Opening balance, trade receivables 100,000. Provision for doubtful debt, opening balance 50,000. This is similar to the questions that we did. Okay, can you complete this? I will take little extra time today. I will finish the trade receivable part today. Okay. Then write off 10,000 as bad debt. Bad debt already is 10,000. We add another 10,000. Total bad debt is 30,000. So that will be credited to the trade receivables. So the net is 90,000. Brought forward is 90,000. Provision is plus 90,000 into 10%. Is 9,000. Oh, sorry. This is not 50,000. This is 5,000. So my mistake. It's 5,000. For 50,000, it's 5,000. It's 90,000 into 10% is 9,000. Right, we will take the provision for doubtful debt. Opening balance is 5,000. I have mistakenly taken 50,000. That should be 5,000. Please make that change. It's 5,000. So now the provision is 9,000. Already 5,000 is there in the opening balance. Therefore, income statement or doubtful debt is only 4,000. So 4,000 is the under provision. And doubtful debt provision is 4,000. That comes from so these are the two expenses. 10,000 bad debt, 4,000 doubtful debt. And the trade receivables 90,000, doubtful debt 9,000. Bad debt is 10,000. Doubtful debt is 4,000. Expense. There is a under provision. First take this one. Example we did without opening provision. Now the second adjustment we did under provision. So next question, I'm going to explain over provision. Let's take the same, but we make some changes. Example 3, with opening balance provision, but over. If you know one, you can do the rest. Okay, if I explain over provision, let's say this is Chamal Traders. Trade receivables 100,000, provision for doubtful debt 13,000. Opening provision is 13,000. In the same adjustments, trade receivables opening balance is 100,000. Doubtful debt opening balance is 13,000. Now the bad debt 20,000 plus 10,000. Which is credited to the trade receivable. The balance is 90,000. Right? The provision is same, 9,000. Provision is 9,000. Out of 90,000, 10% is 9,000. So already 13,000 is provided. Therefore, to have the closing balance as 9,000, we have to decrease this by 4,000. This is how to then from it becomes 9,000. So here what we have done is dividend. When doubtful debt, normally it is an expense. Here minus expense. This is over provision. Within that we can mention this is over provision. It's minus from the distribution expense. The trade receivables would be 90,000 minus 9,000. That doesn't change. 81,000. That is example 3. I have another example. Can you do? So we did with open balance under provision in over provision. Right. So I have another example. Here I can stay, I can do example 4. Now I'm going to explain a specific provision and then so this is also another important part. Example 4. With specific and general provision. Donate. Following details are given for donate traders. Trade receivables 100,000 provision for doubtful. Let's take it as 2,000. Bad debt 20,000. And I will take one example. Bad debt written off is 10,000. Specific provision of 20,000 made for Mr. Ajit. And from the remaining trade receivables, 10% general provision is made as doubtful debts. Right? So this has specific provision and general provision both. Very important adjustment. Example 4. Opening balance for forward 100,000. Doubtful debt opening balance is 2,000. Then there is a bad debt 10,000. 20,000 plus 30,000. So bad debt trade receivable credit. Okay. Now the doubtful debt. So when calculating the doubtful debt, there is a specific provision and a general provision. I'll do a working for the calculation. Now we have total debtors 90,000. Okay. We have total debt as 90,000. Out of this specific, there is one person who need to pay 20,000. So we make 20,000 a specific provision. And remaining 70,000. From the remaining, we need to make 10%. So doubtful debt. From the specific provision, we make 100% as doubtful debt. Entire 20,000 is a specific provision, and from the remaining, we have to make only 10%. So if you take 10%, that's 7,000. So the total doubtful debt will be 27,000. Total doubtful debt will be 27,000. Okay, so you have to do this working, calculating the specific and general. 10% is general provision, 20,000 is specific provision. So do this working. Now the provision should be 27,000. Therefore, we need to increase this 2,000 by 25,000. So that's the expense. Then the closing balance is 27,000. Then the expense doubtful debt 25,000. Okay, so bad debt is 10,000. Doubtful debt is 25,000. 25,000 we calculated by taking the total doubtful debt and difference of opening and closing. Trade receivable is 90,000. Doubtful debt 27,000. Net it has 63,000. This is how you do the specific. There's a question. Why 25,000? 25,000 because total is 27. Opening already 2,000 is there. Opening 2,000 is given. Provision. So total should be 27,000. And the difference is 25. Under provision. That's why 25,000 comes. Okay, so we will complete this. Is it clear? You can understand, because I don't know whether you have understood, then only I can focus the next adjustments. You will respond. This part is very important. Then only it's easy for us to do the financial statements, preparation of financial statements, the sole proprietorship company and all. Okay. Then there's one more part, right? If a specific provision becomes bad debt, only that part is there here. Right? If a specific provision becomes bad debt, that is the double entry. Now already the specific provision we have taken to the income statement. Now he becomes bad debt. Now here, as per this example, Mr. Ajit. For Mr. Ajit, 20,000 we have taken into the income statement. Yeah, this 25,000, this 25,000 is available. Like from this 7,000 only, that additional 5,000 comes. Right, so already in distribution expense, the specific provision has been taken. We have taken the specific provision. Now, if he becomes bad debt, if a specific provision becomes bad debts, again, you can't take it to the income statement. Then the double entry will be, I'll give only the journal entry. This is number 3. A specific provision becomes bad. Double entry. Can someone tell me the double entry? If a specific provision becomes bad debt. Debtors account credit. Receivables credit, because that anyway we have to deduct from the paid receivables. 20,000. Here I assume that Ajit becomes bad debt. What is the debit account? Can you tell me? What is the debit account if a specific provision becomes bad? It's 20,000. We have to deduct from the trade receivables because it was not deducted. We can't debit the income statement because already in income statement you have this 20,000 and it is there in the provision account. This 27,000 includes this 20,000 of specific provision. Therefore, we have to deduct the provision put out to the account. So if a specific provision becomes bad debt, write this double entry for specific provision. Okay, so these are the adjustments that you need to know under trade receivables. I'll show all the adjustments. If you want to take screenshots, you can take it. So we did number one, we did uh, without opening provision. So this example we did without opening provision. Example one. If you want to take a screenshot, you can take it. Then example two. Example two, we did with opening provision, taking under provision. Under provision. Example two. Opening balance 5,000, total 9,000. So only the difference 4,000. It is an expense. Example two. In example three, we took over provision. Over provision. Opening balance 13, then 4,000 deducted from the provision for doubtful debt account, and it was again deducted from the distribution expense. It is over provision. Over provision. Then specific provision and general provision. Specific and general provision. So on the inventories, we will cover the closing stock adjustment. So other adjustments I will do whenever it is required, right? So without confusion, we will start from the basics and we'll finish the basics and move on to complex adjustments. Right? So on the inventories, I did the closing stock adjustment, cost and NRV, taking the cost and net realizable value. Then we did the debtors adjustment, the trade receivable adjustments, bad debt, provision for doubtful debt. So under doubtful debt, under provision, over provision, specific and general provisions. Right. So in the next class, I will explain the accruals, expenses and income. Prepaid expense, expenses payable, then income receivable and income received in advance. So 4 adjustments we need to do on accrual. After that, I will explain the PPE related adjustments. Okay. So thank you for staying today. Almost 3 hours, right? So we'll see you on Thursday. Thursday we'll do the accruals and the PPE adjustment. Okay, so take care and good night. If there's anything, just drop me a message. Okay. God bless you. Take care. Good night.